Let me just start off by saying thank you. I know the commitment. It's been crazy times. And I'm not talking the weather the last 3 days, 4 days. But between last night, we had our State of the Economy presentation up in Saratoga, and this evening we have about 400 clients, and that literally we only had 1 or 2 that didn't show, and it was crazy because the weather last night was as crazy as the weather tonight. And we thought on Monday, because we had 2 snow dates, as you know, ready to go, we said 45, 50 degrees, this is perfect. Everybody's going to be able to come, no problems. Well, I also said last year it was going to be a great year in the stock market, and we know that turned around. So we're going to get into that. But thank you for coming. It means a lot to us. Every time you engage our services, I tell you it's something we don't take lightly. And when the stock markets are going up, we communicate with you. But we feel that our value comes in when there's volatility in the markets, and we really go out of our way to communicate more with you, because we feel that that's really what's expected of us. And when you think of the last 3 State of the Economy presentations, 3 years ago, if you remember January 2nd, China came out with some crazy earnings, or not earnings, but economy news, and the stock market immediately went down the first day that the market opened. And we had our State of the Economy presentation, and it was crazy. And then 2017 came along, we had our State of the Economy presentation, it was uneventful. And then last year we had our State of the Economy presentation, and the night we had our first one, the markets hit that 10.4% correction. If you remember, this January 26th, the markets peaked out, and then all of a sudden they had a couple crazy weeks. And right the first night of our presentation, I said, well, we're timely. What are the chances, again, of us being timely? And I think, again, we're timely with having our State of the Economy presentations, and hopefully all the bad news is gone. But more importantly, hopefully when you leave here tonight, you have a better understanding of what we're thinking and what we're doing. So without any further ado, let's get started. So our state of the firm. One thing that we're proud of, I've been helping clients for about 32, 33 years. I was part of the Black Monday in '87, the credit crisis in the late '90s, the tech bubble of 2000, the Great Recession we all remember. And this is an award that our firm now 2 years in a row, Charles Schwab is our platform. And they have 1,300 wealth management firms across the country that they actually do and measure and benchmark. And out of 72 RIAs, out of the 1,300, we're in the top half of those 72 firms. To put it in perspective, we're in the top 3 to 4% of wealth management firms that Charles Schwab monitors as being best managed for what we do for our clients, the investment we have in human capital and technology and so forth. And we're very proud of that. And we're also, thank you. Thank you. And we're also the only local firm. Charles Schwab has what they call a referral program, and we're the only local wealth management firm that's part of that. Now, part of our success is because of each and every one of you. The best compliment you give us is when you refer clients to us. And we don't take that lightly either. It means a lot to us when you feel that you trust our services and our advice so much that you refer family, friends, co-workers, associates, whoever. We appreciate that, and we thank you for that. And we try to make sure we maintain the level of service, so we continue to invest in our human capital. Right now we have 9 professionals, 4 CFPs, Certified Financial Planners, 1 Certified Public Accountant, CPA, 1 Accredited Investment Fiduciary, AIF, and 1 CFA, Chartered Financial Analyst. And I'd like to have our team come up because we wouldn't be successful. We couldn't give you all that we give you without our team. So let me start off with the real brains and boss of the operation, Angela Cesny, who's been with me for over 20 years. Angie Gavin, our client concierge. and Heidi Balicki to round out our service team. And we have 2 junior wealth advisors. We have Harmony Wagner, who just completed her Certified Financial Planner program a few weeks ago. And one of our newer associates, Paolo La Pietra, who is studying to be a CFP, taking his exam in March. And then our newest associate, David Rath, just joined us on January 2nd. David is our CFA, our Chartered Financial Analyst. And between all of our professionals, hopefully you feel that we are giving you everything that we can give you, because I know that all of us are trying our best to meet your expectations and give you everything. And we wouldn't be the firm that we are without this group. So I couldn't start the show without introducing them and bringing them up here. So thank you. And to round out our team, Marty Shields and Ryan and myself, who are what we refer to as the relationship managers, and working with you and helping you. And let's get started, because I'm telling you, we have a lot going into tonight. So, technology, as I said, not only are we investing in our human capital, but we're investing in our technology. We started quarterly webinars, which are really popular. I'm surprised at how many clients hop on them. If you haven't hopped on them, they're pretty informative. We limit them to 30 minutes, and it's really, truly something that a lot of clients appreciate. We have a Yodlee integration available. Some of you have a couple accounts outside of Schwab. Why, I don't know. But some of you do have a couple accounts outside of Schwab or 401k plans, and you're able to, or we're able to, integrate that in. So if you want to go to one place and see all of your investments, we can do that for you. We have our mobile app that's up and running. We have our financial planning integration, which is really, as you can see, having 4 CFPs, we're doing a lot more financial planning. And if you're interested in having your future laid out for you, please take us up on that. It's something that, we have the expertise, we can help you. And then we have our podcast. Whether you have iTunes, iHeartRadio, or Android, our podcasts are pretty good. So we continue to update our technology. Now let's get started. The tale of the 2 markets, right? We know it's been crazy. And last night in Saratoga, they gave me a green dot, and I like that because green is a much better color than red the last few months. But this is 2018. And as you can see, whether we're looking at the U.S. stock market, international stocks, emerging markets, whether we're looking at large caps, mid caps, small caps, whether we're looking at financials, energy, technology, whether we're looking at fixed income, no matter where the bonds come from, gold, commodities, you get the picture. You don't see much green there. The only green is down here. We have 3 different volatility ETFs that actually made money in 2018. What I'm trying to say is there was no place that an investor could have gone last year and made money. It was one of those years where things just happen, and we're going to get into that. But this chart kind of lays it out. There was nowhere to hide in 2018. The best of times, the worst of times. If you looked at the first 3 quarters of the year, this column right here, and take the large cap equity index, we were up almost 11% the first 3 quarters. The fourth quarter, we were down 14%. For the year, we were down 4.5% almost. If you look at international stocks, for the first 3 quarters, down almost 1.5%. For the fourth quarter, down almost 12.5%. For the year, down almost 14%. Emerging markets, down 7-8% for the first 3 quarters. The fourth quarter, down 7%. For the year, down 15%. Now, people back in the first 3 quarters asked, well, why do I have bonds in my portfolio? Stocks are doing well, and stocks did well. So for the first 3 quarters, bonds only returned 1.6%. For the fourth quarter, they were actually up 1.73%. The only place where you could have made money in the fourth quarter. For the year, they were flat, but at least they weren't down. And the same story with commodities. They're like the international and emerging markets. They just never got out of their own way. So being diversified was good, and the fourth quarter really took a lot out of investors' portfolio returns. Now, we had a lot of volatility. Going back to 2017, that was a year where there was no volatility. And I'm just going to show you real quick. This goes back to 2009. The average volatility where you have 1% up days, 1% down days, 28 and a half days a year. Last year, we had 32 down days where we were down 1% or more, 32 up days where we were up 1% or more. That wasn't nice. That wasn't comfortable at all. And it's a feeling that investors just didn't like. Coming out of 2017 where there were only 4 down days, 4 up days with a lot of movement. So volatility came back, and if you look, it's on average. That's what's to be expected, is that volatility. So we understand it, and we try to tell clients that it's part of being invested. And then last but not least, if you look at earnings, earnings is really the blue shade here. Earnings have really been better over the last couple years. The kind of olive green shade or mustard shade is the PE ratios. And what this chart is showing you is that last year, the market actually lost, the PE multiples, rather than being 16, 17, 18, is now under 15. And let me just jump to the next slide because it kind of sums it up. As we sit here, the market, the broad stock market, is valued at 14.4 times earnings. That's a discount. That means that the market is fairly valued right now, whereas for so long, as you can see back in the late 90s, it was almost 24 times earnings. So being at 14 times earnings is pretty good value. So that just kind of sums up the year. And I'm going to stop there, let Ryan come up and take the next part of the presentation.